Ever wondered why the rich pay less in taxes? It's a provocative question, isn't it? A question that brings to the forefront the complexities and, often, the seeming unfairness of our tax laws. There's a perception, perhaps you share it, that the wealthy are somehow paying less than their fair share. Is it true? If so, how is it possible? These are the questions we're going to dive into. In the next few minutes, we'll unravel this mystery together. To understand the answer, we first need to dive into the world of tax laws. Taxation at its core is the means by which governments finance their expenditure by imposing charges on citizens and corporate entities. It's a complex system, but let's break it down to its basic principles. In many countries, taxes are typically levied on what we call a progressive scale. This means that as a person's income increases, so does their tax rate. Now, this brings us to the concept of tax brackets. Imagine a ladder, where each rung represents a different level of income, and the higher you climb, the more taxes you pay. But here's the catch, you only pay the higher rate on the income that falls within that higher bracket. The income you made at the lower rungs is taxed at the lower rates. But it's not just about how much you earn, it's also about how you earn it. Income is not a one-size-fits-all term in the eyes of tax laws. It's categorized into different types, each with its own set of rules and regulations. First, there's earned income, which comes from things like salaries and wages. This is the type of income that most of us are familiar with, and it's usually subject to the highest tax rates. Next, we have investment income, which comes from dividends, interest, or the sale of an investment like stocks or real estate. This type of income is often taxed at a lower rate than earned income. Why? Well, it's partly to encourage investment and economic growth. Lastly, there's passive income, which comes from business activities in which you're not actively participating, like rental income from properties you own. The tax laws around passive income are a bit more complex and can often be lower than those on earned income. So, with this understanding, let's explore how the wealthy navigate these laws. The rich have mastered the art of legal tax evasion, but how? Well, let's unravel this mystery together. Our first stop on this journey is the land of tax deductions, tax credits, and tax shelters. These are legal tools that the wealthy often have more access to and know how about. Think of tax deductions like coupons for your taxes. They reduce the amount of your income that's subject to tax. For instance, if you make $100,000 a year and have $20,000 in deductions, you're only taxed on $80,000. The rich are often able to find and utilize more of these deductions. Then we have tax credits, which are even stronger than deductions. If deductions are coupons, then tax credits are gift cards. They directly reduce the amount of tax you owe, dollar for dollar. For example, if you owe $10,000 in taxes but have a $2,000 tax credit, you only owe $8,000. The wealthy often have more access to these credits. Next, let's visit tax shelters. These are investments that reduce, defer, or sometimes even eliminate taxes. Real estate, for example, can act as a tax shelter because of depreciation deductions. The rich often invest in these types of assets, which helps them decrease their taxable income. Now let's talk about capital gains, which are the profits from selling an investment. They're taxed differently than regular income, often at a lower rate. This means that if a wealthy individual's income is largely from investments, they could be paying less in taxes than someone who earns a similar amount from a regular job. But that's not all. There are even more mechanisms that the rich employ. Their wealth allows them to hire top-tier tax professionals who can help them navigate the often complex world of tax laws and find even more ways to legally reduce their tax obligations. So don't be fooled, it's not just about having more money, it's about knowing how to keep it. Another tool in the arsenal of the wealthy is offshore accounts and trusts. These are financial accounts or trusts located outside the individual's home country, often in places known as tax havens. Now, why would someone want to do that? It's simple. These jurisdictions typically have low or zero taxes, and they offer a degree of confidentiality that can be attractive to those wanting to reduce their tax bill. Let's break it down. When money is held offshore, it's often out of reach of an individual's home country tax authorities. That means the income generated by these accounts can accumulate, tax-free, allowing the wealth to grow at a much faster pace. Trusts, on the other hand, are legal entities that hold assets for the benefit of others. When set up offshore, they can serve as a shield against home country taxes and offer an added layer of privacy. But here's the catch. While it's legal to hold money in offshore accounts and trusts, it's illegal not to declare this income. And that's where the controversy comes in. Critics argue that these strategies create an unfair advantage for the wealthy, enabling them to sidestep their tax obligations, while others are left bearing the burden. Now that we've looked at these strategies, it's clear that the game isn't rigged, but it's definitely not played on a level playing field. So now you know why the rich seem to pay less in taxes. It's a blend of tax laws, legal tax evasion strategies, and offshore accounts. But remember, it's not about envy or resentment, it's about knowledge. Understand your own tax situation. Consult a professional if you must. Let's aim for financial wisdom, not just wealth. Don't forget to subscribe for more insightful videos like this one. Until next time, stay curious and keep learning.